Hello, friends, and welcome to the Optimized Advisor Podcast, where we focus on optimizing the well-being and best practices of insurance and financial professionals today. On this show, our objective is to help you optimize your life, optimize your profession, and learn from other optimized advisors. I'm your host, Scott Heinela. We hope you enjoy the show. Well, good day to you, Joseph Pantozzi. Thank you for coming on the Optimized Advisor Podcast. It's good to connect with you today.
Good to connect with you, Scott. I'm excited to hear what I have to say.
As I am too, hopefully our listeners. And thank you to all of our listeners to tune in. I would say that today's topic would fit two categories, really. One, learning from another optimized advisor. That's you, in case you didn't know it. And two, really optimizing our practice, because we're going to dive into a segment of the insurance space, life insurance in particular, that has really been the lifeline of your practice over the years, correct? We won't release the secret yet, but we will soon.
Sure. Yeah, it's been the foundation of my practice. I like to think that 90% of my job is helping people to build wealth, and especially to not lose the wealth that they have built. So rule number one, don't lose the money, right?
And how about taxes?
Well, taxes are a fantastic conversation to have. And everybody has a particular viewpoint, right? Everyone has a bias.
Correct.
No matter who the person is, if they say, well, I'm completely unbiased, I'm completely objective, they haven't really thought about it. I'm biased towards peanut butter, and I'm biased away from liver, with all the respect to my Texas wife, right?
Right.
Everybody has a bias. So my bias is towards generational wealth. My bias is towards people who want to build wealth and do something with it.
Correct.
Not towards people who just want to get wealthy and get rich just to be rich, right? With all due respect to Paris Hilton, it's a terrible example because she's a beautiful person and a beautiful soul, and God bless her. But she's probably inherited tens of millions, maybe hundreds of millions of dollars. And at least the impression that the public might get is, hey, we're just building another Paris Hilton. I don't want my kids to be so endowed with my money that they lose all drive and all intention and all motivation to do something with their lives. That's important. So part of transferring generational wealth is not only the money. Maybe it's the most unimportant piece of generational wealth, but it's transmitting those values that we hold dear, right? And we want our kids to share the values that we have, generally speaking. The important values, the spiritual values, the cultural values, the emotional values, the societal values, community values. Again, you're hearing my bias right now. My bias is to help build wealth so that they can do good.
Right. Amen to that. Amen to that. So let's take a little step back and properly kind of introduce you to the audience, talk a little bit about your background, how you got into this business, and how your practice has evolved over the years. So Joseph Pantozzi, as you were saying earlier, you're the chief deck swabber, correct? Is that what we said? What do we say? We joke about that.
Chief cook and deck swabber, yeah.
Founder of Alpha Omega Wealth. In all seriousness, president, you're leading the charge. You're the chief vision officer, if you will, of the organization. And how did that come to be? When did you get into the insurance space? And not that you just do life insurance, but your primary expertise, would you agree, is that of cash value life insurance or sophisticated high-end life insurance planning strategies? Sure.
The way I got into the business was moving to Las Vegas, Nevada at 24 years old, and having no place to hang my hat professionally, and walking into, I guess, opening up a newspaper and seeing a tiny 1-inch ad. And it didn't say it was Metropolitan Life, but it was Metropolitan Life. And I started out knowing no one, and having a script, having a rate book and a phone book, and having not much of a coaching environment, but proceeded to to make a living because I didn't have any other choice. Everyone has to do what they have to do to survive. And I started learning the virtue and the value of cash value whole life insurance issued by a mutual company, which is, again, one of my biases, right? I believe in working with mutual companies. Back then, MetLife was a mutual company. They've since become a stock company. They've gone public, and I don't know how many hundreds of billions of dollars that they have under management. And God bless them, that they've done a lot of great work for a lot of people for maybe 150 years. But I maybe 8 years later went over to another mutual company and continued to learn a little bit more about serving business owners and a little bit more in depth about the value of whole life and what it can do. You're not just buying a policy to have it build up cash value so that you can transfer to your kids for the next 50 years. We're using policy cash value for all the different benefits that it enjoys. So you've got multiple uses of money. So my career, if you will, started out in the insurance space, the guarantee space, life, annuity, disability. And I'll fast forward to 1988 when I met my angel, my wife, and we had kind of a revelation. We had both been kicked in the teeth financially for different reasons, and we committed in 1988. Basically, the first day we got together, June 2nd, 1988, and we knew that our finances were a mess, and we both already had a commitment to God, and we said we're going to give him his. We believe in tithing, another bias, right?
Mm-hmm.
We're Christians. We believe in tithing. We're going to give God the first 10%, and we're going to put ourselves at the top of the food chain for being our own best customer, being our own best banker, being our own best creditor, and we're never going to pay any bill before we pay ourselves first. So that was a value that we adopted in 1988, and we've never gone away from that. And we never have been late in a car payment, never have been late on a mortgage payment, but we had that value so that we would fill up our treasury slowly in the early years, slowly but surely, but make sure that we understand the purpose of gaining income and earnings and commissions and so forth was to take care of our family first.
Yeah.
Right. And then around the turn of the century, around about 2001, I met Nelson Nash, and I was invited to a small conference, a seminar that he was teaching in San Clemente, California.
Okay. Yep.
And there were maybe, I don't think there were 12 or 13 advisors in the room. And we met Nelson Nash, and he had just published his book, Becoming Your Own Banker. Back in the day,
right.
his face was on the cover. His face should have been on the cover, the front cover, not the back cover.
Right.
And several versions later, somebody convinced him to put his name on the back of his picture on the back of the cover. But
I've read the book a few times.
Yeah.
I can't remember which obviously there's been however many editions, because it is a course, it's a class textbook, right? There's a lot of numbers in there. It's very educational. It's not a sales book. It's not a storytelling book. It is the science and the methodology behind the infinite banking concept. So what is the infinite banking concept?
So I'm glad you said it's the science and methodology. That's a really good premise to help lay the foundation. The foundation is really kind of deep and wide.
Right.
And Nelson says that his book is based on imagination, prophecy, reason, and logic. And I'm saying, I don't know if I was too strong in any of those suits back in the day. And when I met Nelson, 20 years into my career, I kind of thought I had it going on. I was a member of the $1 Million Roundtable for a long time. And Nelson started to ask me some questions about my understanding about how money worked, how banking works. I'm like, wait a minute, Nelson, I'm not banking. I'm in insurance and investments and financial planning. He said, well, son, you need to understand how money works for any of those other things to work. And do you know how much banks and lending institutions control your life? And over the next 20 years, I was privileged to be mentored by Nelson Nash until he died in 2019. And
How old was he when he passed away?
he was 88.
Okay, good life.
Yeah, yeah, good life. He called me up
Yeah.
one day and said, "Son, I got to go over to Napa Auto Parts and pick up a valve." I wish I could. I wish I could do justice to his beautiful Birmingham, Alabama accent.
Right, the draw.
Yeah, and he said, "I'm either gonna be fixed for a while, or I'm not going to make it off the table." And he didn't make it off the table.
Yeah,
But
that's too bad.
beautiful man, beautiful testimony, beautiful faith, beautiful wife, married, beautiful family, great grandchildren, and left knowledge and wisdom for probably hundreds of advisors, and I'm sure tens of thousands, if not more, clients. So I
Yeah,
was making some notes this morning. If I could just throw this in, you know,
please.
so many people will read something, they'll listen to something, they'll watch a podcast or a YouTube piece, and they'll say, okay, I got to buy this thing. I got to work with this advisor. I got to change this one thing. You know what? It's not about changing one thing. It's not about buying one thing. It's a lifestyle. And the lifestyle is I'm going to have to be committed to educating myself, because
Hmm.
if a person just starts swallowing all the lines that are out there, what they're going to wind up doing is putting a new product into an old system. You know, there's some wisdom there about putting new wine in new bottles and old wine in old bottles. You wind up
Right.
putting new wine in old bottles. Um, they're gonna break the bottles. I know that I totally botched that, but if you're going to be involved in the infinite banking concept, you first need to understand it's an advanced course on money,
Right.
and it's going to challenge you to reevaluate the understanding that you have about how money works, how banking works, how the government taxation works and the government control over our money, how Wall Street is involved, how insurance companies work. And so the essence of the infinite banking concept is learning how to get back control that we've given away, get back control of the banking function, because the
Right.
banking function is what causes us to send most of our money outward, right? And we lose control of our money, and money is flowing outward. The infinite banking concept is all about getting you to learn how to draw money toward you instead of having it go away from you.
Interesting. Yeah, I mean, so the examples that obviously are coined by the banking concept, and the easiest analogy is when you go to buy a car and how the financing of the lending of the vehicle works. But I like to shift away from that for the simple fact that how can we utilize this concept to directly leverage appreciating assets, maybe it's investment properties, things this other investments that I could leverage the value of the cash value in to continue to create more velocity and generate more wealth. Is that
Yeah.
applicable?
That's a great question. That's a great setup. I wish I had scripted that question for you. So three things. One is using the infinite banking concept to finance your cars is absolutely important, and
Right.
it's great practice, because when you start to finance your own cars, which I've done since 2003, if you start to finance your own cars, you will literally see on your net worth statement that you're going to be gaining net worth in dollars that you didn't have before, because you were paying someone else, you're paying interest out, you were losing control of the vehicle, control of the salvage value, whatever. But
Hmm.
now every time I buy another car, I gain more equity, right? So it's like IBC infinite banking concept on training wheels. When you're financing your cars, you should
Right.
absolutely do that. But then you have to realize that any asset that you have, if you're not getting it to move money, you might as well just have money sitting in a CD paying 2%, It's not a
Right.
good example. Have your money sitting someplace. Have it sitting in checking. Have it sitting under the mattress, or even having it sit in a life insurance policy. Because you just hit the nail on the head. The whole idea behind building wealth using infinite banking is not that the wealth is going to reside in your policies, but when you start to create this family banking system, then you're going to learn how to capitalize the investments that you want to build,
Right.
whether business or businesses that you own, whether it's cash flowing real estate, even if it's investments in the stock market. I can't think of any other major categories where you would put money. Right, real estate, stock market, and serial entrepreneurs,
Right. Right. Right.
entrepreneurship.
Right.
Right, I own a Krispy Kreme, I own a gas station, I own a dry cleaners. All right, a department store, whatever you like to own. I tell people that is where you're actually taking the biggest risks of your life. When you put the key in the door, there's high risk. Right? People don't understand who are not business owners. That's the biggest risk you'll ever take. You don't have to worry about buying investments that are high risk. You already own plenty of that.
Right.
Right. So you start to learn how to capitalize your business using your own capital account, your own capital fund, and create leverage, the right kind of leverage, smart leverage, not dumb leverage, not toxic wealth. Then you're going to see how your wealth is gonna multiply. But at the same time, your capital account that you're using to finance it is going to be a conservative vehicle, which itself is going to gain in equity. So now
Yeah.
you're making money in two ways. You're making money from your investment, your cash flow real estate, or your businesses, and you're also making money in the financing vehicle. You control both. So control is a big thing, and control leads to freedom.
So the cash flow of life insurance is kind of where the capital remains idle. I understand earning interest, which is a good thing. So better than probably the bank. Certainly a mutually owned whole life policy because you're getting interest as well as basically dividends, correct?
Yeah, they don't use the word interest when it comes to a life insurance policy because there's a schedule. It's a guaranteed schedule. It becomes a little bit more esoteric, but an actuary would say no, life insurance policies don't earn interest. They just don't. They have a guaranteed schedule of cash value plus dividends. But I'd say the concept is the same.
Right.
You're building money on money. You're still getting compound.
Right. So the idea then is, to build the capital structure that is the idle point to then go out and create more wealth, whether that's investment in, or expenditures in vehicles, or better yet, investment in wealth creating opportunities.
Sure. And I think a mistake that people make is looking at those things and saying, okay, if I'm going to build wealth, I have to buy cash flowing real estate. I have to get involved in a business. You really shouldn't get involved in anything you don't understand
Mm-hmm.
and you don't want to do. Don't do it because you think
You
somebody
should.
else expects it of you. Don't do it because you think that's the only formula. Listen, if your formula for security and comfort in your life is safety, and you're comfortable with $1 million in a CD or $5 million in a muni bond, don't do something that goes out of your comfort zone. I mean, maybe a little bit outside your comfort zone,
Right.
right? Somebody says, well, I think I want to invest in gold and silver. Well, maybe somebody who's worth, some number would put 5% of their net worth in gold and silver. They're certainly not going to put 50% in
Right.
gold and silver because it has no cash flow.
Right.
Right.
Okay, so now I want to go back a little bit from a marketing element of this. You go to San Clemente's 2001, you walk out of there, you're enlightened. You've been introduced to IVC. You think, you know what? I'm going back to Las Vegas, which I'd love to talk a little bit about. It's a very unique and challenging town that I've, with the years that we've worked together. It's different than many other cities and metroplexes throughout the country. So what unique challenges did you experience, do you think, in Vegas? One, and the second part of that is how did you begin marketing this and getting yourself out there in this concept and in this strategy in and of itself?
I love these complex questions. They're like 4-part questions. That's fantastic.
They are. Well, you can
So,
take it however you'd like.
yeah, no, I'm good with that. So number one, I came back so enlightened that I had the book under a pile for about a year and a half before I did anything with it. And you know why? Because Nelson talks about something called Parkinson's law, right? A luxury once enjoyed becomes a necessity, right? A cell phone is a luxury. 30 years ago, it was a non-issue. It wasn't
Correct.
something we thought about. And I came back and I was already kind of on the road as a member of the $1 Million Round Table. I was doing well. My clients liked what I brought to the table. I thought I know I had integrity. I was honest, and I was diligent, and I was a hard worker.
Right.
And things were going well.
So you had a good business. In 2001, you had a good business.
Yeah.
Things were humming right along.
Yeah. And for a year and a half, I said, you know what? I don't know that I just need to read another book, because it was just another book.
Right.
But I didn't take to heart what Nelson had said to me. But then a year and a half later, I was encouraged to go back. And now, by the way, that was a 10-hour seminar.
Wow.
I was encouraged to go back and meet him again. I've flown to different cities, and over time, once I got the bug, now I was inviting Nelson to my house. And my wife and I would invite Nelson and Mary, because he never traveled without Mary. And now I would invite Nelson. We would have seminars. We would invite our clients and maybe a few prospective clients to seminars that were, in-seat seminars. We would have sometimes only 15, 20 people, sometimes 30, sometimes 40, sometimes 60, 70 in different venues, mostly in Las Vegas. And Nelson would speak, and he would speak for 2 hours on Thursday night. And we would have hors d'oeuvres and light refreshments. And then they would come back on Friday, and he would do it 8 hours on Friday.
Oh my God.
And after a while, I said, Nelson, some of our clients and prospective clients, they're just not crazy about committing a day and a half. And we're going to get some drop off. So could you kindly reduce or compress our time together to a full day? And he said, I'll do the best I can. And anybody who's ever attended a Nelson Nash seminar will know that he said the same identical thing at the same identical hour. He drank coffee all day long.
Mm-hmm.
He told the same jokes at the same identical time. And what he did was he laid such a beautiful foundation. Then clients would come to me and say, okay, how do I execute?
Right.
How do I apply this in my life? And he explained very, very openly, this involves utilizing a cash value whole life policy. And if you have whole life policies, absolutely we can use them. But once you get the hang of how this is going to work, you're probably not going to be satisfied with what you have. You're probably going to want to build it 10x.
Right.
And a lot of clients have, because back in the day, before I met Nelson, I was sharing with a client what kind of life insurance would be good for them, what I thought that they should have, what they could afford, so forth and so on, based on their budget. And they'd buy a product based on a price.
Right.
And then after I met Nelson, clients would look at this and they would say, kind of on the sly, so how much can I get in this thing? So it was no longer a matter of what's it going to cost me. It was a matter of how much can I get in it, because they were getting the understanding that I've learned over the years. That's not how banks and Fortune 500 companies buy it. They pour as much cash as they possibly can pour into a policy, and then they control it with all the different attributes that a policy has.
Right.
So that's what turned my business around. And when we start to explain to our clients, actually, your equity in your policy is going to appear in year one. So you're going to have access to cash flow from your policy in year one, and that you can then turn around and start getting rid of some of that toxic debt and take over your leases and get rid of your credit cards and start to build wealth using leverage in-house. And I had to do an inventory of my own financial house and realize I wasn't even cutting the grass when it comes to my own policies.
Right.
because I thought I was big time, paying $1,000 or $2,000 a month in life insurance premiums. And when Nelson asked me one day, so son, um, what's the most valuable asset you have? And I know you're not going to say your house. I said, no, it's my income. I understand it's my income, Nelson. So then are you putting more money? Are you putting more money into your mortgage payment, or are you putting more money into your life
Life
insurance
insurance.
program?
Right.
He said, ouch, I'm putting more money into my mortgage program. He said, why is that? And that put things in perspective for me.
Right.
And so now, it's been many, many, many years since my wife and I only put away 10% for ourselves. Now you could live a lot of people could live a very nice lifestyle on the
Right.
premium that I put into my life insurance policies, because all I'm doing is taking money from my earned income and I'm putting it into the other pocket, which is my life insurance portfolio. And it's a large portfolio, maybe 30 or so policies.
Right.
With
Wow.
some of them are plus years old.
Right. Wow.
So our clients, we explain to our clients, the way we build this policy, our commission within the policy actually dropped like a rock. We cut our commissions out by 60%.
Correct.
I'm living on 40% of what I used to live on before. You'd think my lifestyle and my personal income would have gone down by 40%. Our revenue went up by 500%
Wow.
because our clients are coming and saying, well, yeah, that's a great idea to put a couple $1,000s a month, but I'm not interested in that. I'm interested in putting away large sums of money, 6 figures.
Right.
Some clients, 7 figures. So the concept can be adapted to anybody's budget or anybody's balance sheet. So what we're doing is we're following what banks do with their tier 1 capital. I mean, banks, the biggest banks, are putting 25% of their tier 1 capital, billions of dollars, into life insurance policies, and nobody knows this.
Hmm.
And the banks aren't going to advertise it because they don't want people taking their money and going direct to the insurance company. They
Right.
want
Right.
people
Right.
to put deposits in so the banks can buy the insurance and the banks can benefit from it.
Fascinating. Hmm.
So we're just doing what banks do. We're just doing what Fortune 500 companies do.
Now, in within Clark County, let's put it that way, right?
Yeah.
Would you agree or disagree that it's a transient population in many cases? I guess I'm asking, what unique challenges did you see within your core market, if any, outside of the norm? But you've also, I know, over the years have now expanded more on a national perspective, meaning you have clients all over the country.
Yeah, we have clients all over the country, and we have agents in 10 states now, from Pennsylvania out to Seattle, Washington, down to
California.
Central California, and a bunch of states in between. So my practice personally is divided up between serving my clients and mentoring and coaching new agents, because I'm totally committed to this industry, because I believe it's the best industry on the planet because of how we serve people and what we do to serve people. And so I want to continue to replicate myself and leave a bigger footprint and help agents acquire financial literacy and encourage their clients to do the same.
Right.
So, okay, challenges for Las Vegas. I was told when I first set foot in Las Vegas, as a financial advisor, as an insurance broker, it's a very transient town. Companies that have large agencies or want to have large agencies are always going to be challenged. And that's totally been the truth. Totally been the truth. I mean, my agency is 90% outside the state of Nevada.
Right.
90%
Okay.
of my agents are outside Nevada.
Right.
So there's an element to that. There's an element of the transient quality. Now, I guess balancing that out is I kind of put blinders on, and I said, I'm not going to let myself be swayed by the glitz and the lights and the people who work on the strip and the hotels, and the casinos and the entertainers, because those are typically not my clients.
They're not.
I'm
Okay.
not going to try to cater to them or make them clients, but there is a strong, um, deep foundation of, let's say, ordinary people
Mm-hmm.
who live in Las Vegas. So there's 2.2 million people there. So they need a lot of doctors. Unfortunately, they need a lot of lawyers.
Right. Right.
They need a lot of real estate people. They need a lot of CPAs. They built up Las Vegas over the last 50 years. Right, there was 200,000 people when I moved there. There were 2.2 million when I left. They need architects. They need contractors. They need all the ancillary businesses relating to a city that's growing.
Yeah, to
So
support the economy.
I focused my practice on meeting up with people that are kind of ordinary people who are, I guess, not entertainment related.
Got it.
And there are tons and tons of those.
Yeah, with 2.2 million. I mean, I know when you moved there, 200,000, so it grew to that over the years. There's certainly a tremendous population that you can reach and connect with. And I guess that's the takeaway too, is even though a community may quote unquote seem small in the beginning and or even today, there's still a tremendous opportunity within any community. I mean, we work with many advisors all across the country, and some are working in very small marketplaces, relatively speaking. They don't have 2+ million people in their county and within their local community, but they're driving success, they're driving results, they have a business plan, they're executing their business plan. And like you, I would say many of them are core to what it is they're trying to solve or the
Mm-hmm.
value that they're trying to bring. And they
Mm-hmm.
are very focused in that, as opposed to trying to do everything and being fragmented.
So, people are people, and the only difference between a W-2 wage earner, somebody who works for a company, somebody who's an employee, you could be a physician or an attorney, but you're an employee because you draw a paycheck from some company.
Mm-hmm.
But so the issue with business owners is maybe they have more of the same issues. Maybe they have more complex issues. They're serving their customers and they're also serving their employees. So when I meet with business owners, they have the same issues that a non-business owner has. How do I save more money? How do I become more efficient? How do I put money aside for retirement? How do I position my company so I can either sell it or transfer it to the next generation, or if I'm going to continue the business for the next 50 or 60 years and family members are going to take over, how do I take and extract some cash for myself? How do I separate some money from the business? And then there are a lot of basic issues, and you can take any checklist you want. Are you covered adequately for health insurance, disability insurance, life insurance? Do you have an umbrella policy? Right?
Mm-hmm.
If you go down this checklist, 9 out of 10 people will say, "Oh yeah, my plan isn't perfect. I've got some things I've been wanting to do for the past several years and haven't got around to, and all of a sudden, 10 years went by and I'm still there." I just started to work with a client who's in his early 70s, who's worth in the tens of millions of dollars, doesn't have a will. That's more the rule than the exception. Doesn't have a will, got assets in multiple states.
Hmm.
Now, we're not estate planners, we're not attorneys, but we'll work within the framework of their team, work as a facilitator and help the client or encourage the client to meet with this attorney or that attorney and get all their ducks in a row. Put those documents together. Find the people that they want to have for their trustees and their guardians and so forth. So a lot of what we do is very, very basic, and it just may appear a little bit more technical or complex from the surface, but underneath, people buy insurance because they love somebody or they owe somebody. And everything else is kind of a variation on that theme.
Yeah. Can we talk a minute or two about product?
Sure.
So whole life is core to this principle, right? And to your business.
Right. Mm-hmm.
I'm sure you get this asked. Why not index universal life?
Okay. So again, my bias will come in, and of course, you need to be able to
Well, and I
defend.
appreciate that. That's I guess that's why I'm asking this
Yeah,
is from a positive standpoint in explaining your bias.
sure, sure. So my bias goes back to about 1980 when I was already in the business a few years, and E.F. Hutton comes out with Universal Life,
Hmm.
and not 1 or 2 years later, the prime rate was around 16%. And those universal life policies were projecting, illustrating 16, 17, 18%. And of course,
Well, and though and those panned out beautifully, right?
well, yeah, for about a minute.
Early
Before,
on, I was going to ask when you met your beautiful, the better half, sweetheart,
uh,
by the way, in '88. What were interest rates? What was your mortgage at then? You think
um,
about that.
because my finances were a mess in the late 80s, 10 years into the business, I remember getting a loan that was around 10%. Early 80s, I had a 13% mortgage.
Yeah.
So it settled down to about 10 because my credit wasn't good. And then once I rehabilitated my credit, we went back into the 7 or 8% range. But even
Still high.
recently, when we bought this house in April, our rate was just maybe a tad above 3.1. But even in 3 months, it's gone up to the fives. So it's gone up 60% when you think about it.
Yeah.
So rates have been crazy.
Yeah.
And oh, by the way, another plug for product. If you build a capital account inside a life insurance policy, you're not going to appreciate the borrowing value inside a policy when mortgage rates are 3%, right? But when mortgage rates start to go up above 5 or above 6, and lines of credit or business credit is now going into 6, 7, 8% range, depending on your business and so forth, you're really going to love the ability to borrow against your policies because you're not withdrawing the policies, you're using it as collateral. The insurance
Right.
company is giving you a loan at interest only at 4%.
Right.
And then even some clients who are maybe more sophisticated, have more equity in their policies, we're aligning them with companies, with banks. They're lending on those cash values in the 3 and 4% range. So don't worry about whether rates are 3 or 4 or 5%, but think about sometime in the future when rates are going to go back to 8 and 10 and 15%.
Right.
And you're gonna really love the idea that you've got whatever the number is, 50,000, 100,000, $1 million in an account that you could borrow against at 4%. And Nelson told us, when you've got money that you have access to at 4%, interest only for as long as you want, and there are other people out there who have needs, you know what you become? Potentially a lender,
Yeah. That's a
right?
good
And there
point.
are a lot,
Yeah.
a lot of, lot
Absolutely.
of things to discuss about that. I mean, you're not going to just be giving out money, lending out money willy nilly without collateral, without documentation, without having a solid borrower, right? Those are separate issues.
Well, no, but that becomes the mechanism for you to become an official, from a private perspective, a lender, right? So it's building that structure, and you can promissory notes, collateral, all the things that go with that. No different than how a bank would operate when lending money to their customers. If you don't need and use the capital yourself, right?
Right. And so the same people back in the day who would say, well, I can't even fathom putting, $1,000 or $5,000 a month into some vehicle for some future purpose. Those same people are going to get to the age that I'm at now, which is, older. They're going to get to retirement like age, and they're going to say, gee, I wonder why my account is only, you know, $85,000 altogether. You,
Hmm.
you look at the stats, and they say the average person who has a 401k account over the age of 65 has $250,000 in their balance. Well, that's very interesting to see an average, but averages are very, very misleading.
Right.
If you look at the median, in other words, the median is right in the middle. 50% of the people have more than that. 50% of the people have less than that. That number for 65 or older is about $80,000.
Wow.
So they work their whole life, and if their primary asset is their 401k, which for a lot of people it is, what were you doing for the last 40 years? I
Right.
mean, it's not. I'm not the message. I'm just the messenger. Right?
Correct.
Don't shoot the messenger. You want to have a decent lifestyle for those 40 years in retirement, you need to start really getting serious about it. At the same time, teaching your kids the realities of people living longer.
Absolutely.
So,
Yeah. Well, we're running out of time. I guess I would end with this. Thank you for your time. Number one. Number two, any parting words or words of wisdom that you can instill upon the listeners who are particularly interested in doing more with cash value life insurance?
sure. Thank you for that. I really appreciate my time with you all the time. So, your finances are not a sprint, they're a marathon. Your financial life is a marathon, and the finish line is not retirement. So many people start thinking about these radical changes when they get to retirement.
Yeah, it's a great point. The mindset should be almost that's when your financial journey like really begins because now you're living 30 plus years without wages.
Right, right. And I read, and I believe this is true. I've read it from several different sources that when people attempt to make the ascent of Mount Everest, more people die on the descent
Absolutely.
than they do on the ascent.
Correct.
And this may be a metaphor. I'm not sure how those things work, but it may be true that people get into more trouble because they're desperate because they haven't hit the marks that they wanted to hit for whatever reason. Right? Life gets in the way. And it always will. They haven't hit the marks they wanted to hit. And now all of a sudden they're retirement age, and they say, "Well, now I have to start taking more risk because of my needs. I didn't buy long-term care. I have a disabled spouse. Whatever the issue is."
Too much investment risk,
Right?
we can go on and on.
Sure. But and it's hard to convey those thoughts and those images to kids who are 25 and 35 and 40 years old and say, no matter what you might be thinking, you're going to be that person one day. And, you've got to resist the temptation to dip into those emergency savings during your working years, your earning years, your child raising years, and your business building years. So if it takes 2 accounts or 3 accounts or 4 accounts for you to get to where you need to go, well then, gee, maybe you need to have a separate account to make that trip to San Diego Wild Animal Park one day. You don't want to deplete your emergency savings. Those are 2 different things.
Hmm.
So I'd say we still need to pay attention to the basics. As Americans, we make more money than anybody on the planet. And like I said, the luxury once enjoyed becomes a necessity. So we make more money, we spend more money, we're in more debt. And our government is almost representative of the individual because the government seems to think it can keep on printing money and going into debt forever, forever, forever. It's not going to work. And what we're talking about is being diligent with your money. You can't control what the government does. You can control what you do in your own house, your own business, your own family, your own heirs. Have these conversations. Have family conversations about money. I know that's tough. People
Hmm.
would sooner talk about their immortal soul than they would about their money. I find that interesting.
Very
People,
interesting.
people,
Yeah.
and people are private about it.
The other analogy is people spend considerably more time spending their planning their vacations than they do their retirement.
For sure. For sure. Yep. And maybe they don't want to talk about their finances simply because they're a little bit embarrassed. But I guess my response to that is, listen, we're all in the same boat.
Yeah.
We're just people. And for me and for you, I know, Scott, I know your heart. We're just here to help people,
Yeah.
help you figure it out. And there may be 50 things you need to do. Just start with one at a time.
So with that said, how do our listeners engage with Alpha Omega and Joe? How do they get in touch with you?
So you could reach me at my office number, 702-430-4400. Or you can go to my website, alphaomegawealth.com, and just hunt around there. You'll see the values that we talk about, the things that we believe we can help you with. We'll talk about our team. We kind of have a very deep bench in terms of our advisors, professional advisors in our back room, valuation services for businesses, et cetera. I love to be able to steer clients to the professionals that they need. They may not all be under my roof, but I'm happy to talk with the client and their present advisors. I mean, this is kind of a new thing for others. It's not new for me. I don't want to do anything with you or for you that your present advisor is not going to agree with.
Right.
And I want to help your present advisor become better. Maybe I can learn from them.
Absolutely.
So it's not about a contest between me and an advisor. It's about helping the client.
And that's a refreshing mindset in and of itself. So kudos to you. Thank you for tuning in and being here. Cheers to you, my friend. Till next time.
Thanks, Scott. Appreciate you.
Thank you for tuning in to today's episode. Please subscribe, like, share, leave a comment or review. Be sure to check us out on social media at Optimized Advisor Podcast. Till next time.